If you're retired with over $1 million and you're still checking the S&P 500 every day, you're measuring the wrong thing. And I know that sounds crazy because for the last 20, 30, and maybe even 40 years, you've been told that the goal is to match or beat the S&P 500. That's the benchmark for success, right? But here's what nobody tells you. There's a specific moment when you're near retirement or already retired when that stops being true, where the S&P becomes almost irrelevant to whether your retirement actually works. Most retirees with seven figures never make this shift. They keep playing the accumulation game, even though they've already made it. And it can cost them in taxes, in stress, and in bad decisions during market drawdowns. So in the next 8 minutes, I'm going to show you why the S&P 500's long-term average means nothing to you if you retire at the wrong time, why comparing your retirement portfolio to an all-equity index is setting you up to fail, and the 3 risk measures that actually matter once you start living off your money. But first, we need to start with a very clear example of why this even matters to you. From October 2007 to March 2009, otherwise known as the Great Recession, the S&P 500 fell about 57% from peak to trough. If you were 55 and still working, it certainly hurt, don't get me wrong, but you eventually recovered. You kept contributing through the dip, maybe you were even buying low, and then you came out fine assuming you didn't sell. But if you were 65 and just retired and you started taking withdrawals from your portfolio, well, that 57% drop while you're pulling $40,000 or $50,000 a year from your portfolio, that's called sequence of returns risk, and it can permanently damage your retirement plans. Because you're not just losing money in the market, you're locking in losses by selling those shares at depressed values to fund your lifestyle. You can't wait for the recovery because you need to eat, you need to pay your mortgage, and you need to cover your healthcare bills. We call this time period the retirement risk zone. It's the 10 years leading up to retirement and the 10 years after retirement where your portfolio is the most vulnerable. This is exactly why Morningstar's 2026 safe withdrawal rate guidance is 3.9% and not 10%, which is the market's long-term average. So on $1 million portfolio, that's about $39,000 a year before taxes. So notice what matters here for retirees. It's not whether the S&P did 12%, 8%, or negative 10% this year. It's whether your plan, your withdrawal strategy, your asset allocation, and your cash reserves can support the income needs that you have through good markets and through bad markets. So there's a critical distinction that we need to make. Your portfolio in retirement is not the market. The market should move differently than your portfolio. That's why I say that the S&P 500 as a benchmark should be irrelevant to you as a retirement investor. You can't spend the average, you spend the sequence. Now, once you're retired, there's a second reason the S&P 500 stops being a useful benchmark. Most retirement portfolios aren't 100% US large cap stocks, so you're not really comparing apples to apples in the first place. Retirees usually carry a mix, maybe 80-20, 70-30, or 60-40, because they need stability, liquidity for withdrawals, and a risk profile that they can live with, right? It all makes sense. So if you're measuring your success against an all-equity index while you're intentionally holding bonds and cash, you're setting yourself up to feel like you're underperforming, even though your portfolio is more than likely doing exactly what it's supposed to be doing. And here's where it gets even more important. Even those allocation labels, 80-20, 70-30, 60-40, can be very misleading for retirees in the same way that the S&P 500 comparison is misleading, because allocation is not the same thing as risk. Asset allocation is a label, not a measurement. So 60-40 sounds prudent, but it doesn't actually tell you what you own, how volatile your portfolio is, or how it's going to behave when the market gets ugly. Because 60-40 could mean 60% in S&P 500 ETF and 40% in US Treasuries, or it could mean 60% all in Tesla and 40% all in junk bonds. It's the same allocation on paper, but completely different risk profiles in real life. So if you're retired and you want to measure what actually matters, you need to stop asking, how do I compare to the S&P 500? And even stop relying on what's my allocation as a shorthand for safety. And you need to start asking, what are my portfolio risk metrics? At Peak, we focus on 3 risk metrics that will tell you the truth faster than any allocation label. It's going to be your standard deviation, your beta, and your Sharpe ratio. So your standard deviation is the simplest way to describe how wild the ride is expected to be for you, meaning how much your returns typically swing year to year. And for retirees, volatility isn't just uncomfortable, it's actually dangerous when you're withdrawing from your portfolio. You see, 2 portfolios can have the same average return, but one with much higher volatility, and it's more likely to force you to have to sell at wrong times, which is exactly how retirement plans get permanently damaged. That's why the old adage, the S&P returned X% isn't the right metric in this phase for you. Remember, you can't spend the average, you spend the sequence. Now, moving on to beta, that answers a different question. How much does your portfolio move with the market? If your beta is close to 1, you're basically riding the S&P. If it's higher than 1, you're actually amplifying market moves. If it's lower than 1, you're dampening them. And most retirees don't need a beta of 1 because when you're in accumulation phase, you can justify taking full market risk because you're adding money to your portfolio and you have time to ride out potential drawdowns. But in retirement, you're living off your portfolio. So what matters isn't whether or not you kept up with the S&P, it's whether your sensitivity to the market matches what you can tolerate and what your plan can sustain. And then finally, there's Sharpe ratio, which is one of the cleanest ways to measure whether you were actually compensated for the risk that you took. The S&P 500 can have an amazing year, but if you took a stomach-churning level of volatility to get that return, the risk is that it could blow up your withdrawal plan if it doesn't pan out the same way later on in retirement. Because retirement isn't about just maximizing returns for maximizing returns' sake. It's about maximizing the profitability of success per unit of risk that you're willing to take on. So once you retire with around $1 million, the game changes. Stop asking, did I beat the S&P 500? And start asking, did I get enough return for the risks that I took? And does my risk profile support my withdrawals through good and bad decades? I can't hammer that home enough. Now, I get it, these metrics don't capture every risk, but they are far closer to the truth than a simple allocation label because 2 retirees can have the same allocation on paper and one has a portfolio that behaves like a steady engine and the other one has basically a leveraged bet wearing a 60-40 mask. That's why after $1 million, the S&P 500 becomes a weak scoreboard for you. What matters is whether your portfolio risk metrics measure or match your retirement plan and what your plan needs to support it. Now, let me take a step back and briefly explain why everyone is obsessed with the S&P 500 in the first place. From 1928 through the third quarter of 2025, the S&P 500 has averaged about 10.12% annualized returns. That's why you see a lot of just buy the S&P, sit back and relax, plastered all over Reddit and even on YouTube, because the math does work over a very long period. And during your accumulation years, your 30s, your 40s, and even your early 50s, tracking the S&P does make sense. You were contributing regularly, you were reinvesting dividends, and you're trying to build wealth as efficiently as possible. That's the name of the game when it was in growth and accumulation mode. Plus, we know that most institutional investors can't consistently beat the S&P 500 anyways. Every year, the SPIVA scorecard shows us that the vast majority of active fund managers underperform their benchmarks over the long term. So the cultural message becomes, don't try to be fancy, just own the index. So I think you get it by now. That works when you're building wealth, but what about once you're retired and you're trying to live off your wealth? Well, that's where the rules completely change. When you have $1 million in your retirement account, a 10% market move up or down is $100,000. Meanwhile, the maximum you could have contributed as an employee to your 401k in 2026, $24,500. So listen to that again. Your portfolio can swing by 4 times more than what you used to be able to contribute on an annual basis in a single year, if that. So now you're no longer adding money, you're taking it out. And so it does change everything. So now once you're retired with $1 million, the S&P 500 stops being your scoreboard because retirement success is about your withdrawal strategy, risk metrics, and sequence risk, not just beating an arbitrary index. But here's what most retirees don't realize. There's another major shift that happens once you cross the $2 million threshold in retirement savings. And it's not just more of the same. The planning strategies that work at $1 million could actually hurt you at $2 million or more if you're not careful. Things like Roth conversions, Social Security timing, even your asset allocation, they all need to be completely rethought. Because at $2 million in retirement, you're dealing with different tax brackets, different Medicare surcharges potentially, and honestly, a completely different set of problems that most financial content don't really address, or at least address well. So if you want to understand what changes you have when you cross the $2 million threshold in retirement and how to avoid making mistakes that could cost 6 figures in unnecessary taxes, click this next video. I break down exactly that and the points that you need to understand in order to do things differently.